Okay, continue our discussion of P/E ratios. So we go back to a simplified version of our formula where the P/E ratio is equal to 1 minus the plowback ratio divided by the required rate of return minus the growth rate. Everything else equal, risky stocks are going to have a lower P/E multiple because this K, or the required rate of return, is going to be higher. So the higher this number is, the lower the PE ratio is going to be, the lower the price of the stock is going to be. So we can also see from figure 13.3 that PE ratios are sensitive to the inflation rate, meaning that when we have higher inflation, the PE ratios are going to fall. And for the most part, I think that this is due to investor uncertainty that comes along with high inflation. I would suspect that all these numbers out here are from the 70s and 80s. This is from the S&P 500 from 1955 to 2016. So when inflation rates are higher, we're going to see lower PEs. That's all this slide is telling us. There are pitfalls in PE analysis. The main pitfall is earnings management. So what is earnings management? Earnings management is the practice of using flexibility in accounting rules to improve the appearance or apparent profitability of a firm. We saw very significant events of earnings management to the point of fraud and during the tech boom and Enron and so forth. Those are extreme cases of earnings management, but on an everyday basis, firms have the ability to manipulate their earnings report within the accounting rules that they go by. Figure 13.4, it shows earning growth for two companies. We've got Con Ed. Con Ed is a utility. Obviously, PepsiCo is a multinational corporation, so not surprising that we see earnings per share growth for PepsiCo of much greater level than Con Ed. I think Con Ed's earnings growth in this chart are in the neighborhood of 20% or something of that nature. And PepsiCo's are just shy of 300% on this chart. So, which is not surprising. We would expect that PepsiCo would grow at a much greater rate than a utility would. If we go to the next slide, we see that price earnings ratios reflect that. They reflect they both jump around considerably. However, PepsiCo's is generally higher than Con Ed's, or it's higher in all cases, which reflects the greater growth opportunities that PepsiCo has in relation to Con Ed. So we can combine PE analysis with the dividend discount model, and what we do is we take the earnings per share and we estimate the stock price on a horizon date, and then we will present value it back to the current date to get the intrinsic value of the stock. And the example in the book uses Chevron, and we have a earnings per share forecast from value line of $9.75, and we use that information to calculate the value in 2021, and then we present value that and all the expected future dividends back. It looks very much like a two-stage our non-constant growth model. We also use other valuation ratios, although price earnings ratio is by far the most widely used. We use other ratios. Price to book is an indication of how aggressively a firm is valued by the market. A firm with a low price to book ratio is considered to be undervalued. We also use price to cash flow because cash flow is less affected by accounting decisions than earnings. So if a firm was suspected of manipulating their earnings, investors might look at price to cash flow. We also use price to sales for young companies or startups without earnings. So the next slide shows valuation ratios for S&P. The S&P 500 from 1955 to current day. We got P. We can see that the P is much more volatile than the price to sales or the price to cash flow. Again, these are shown because these are used because they're less volatile and less subject to manipulation by accounting rules.